Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Tuesday, November 8th, and oil markets are trading a little bit down this morning in Asia. Brent has come off ever so slightly, somewhat insignificant move, but nonetheless, that assault on $100 a barrel on Brent does seem to be, at least for this current window early in the week, suspended. Let's go to our regular commentator, Ole Hansen, head of commodity strategy, Saxo Bank. Ole, your thoughts on where the market's at the moment? It feels like we're caught in the between. You wouldn't be surprised to wake up and see a $10 pop up above 100 or a $10 drop off to below 90. Where do you think the market dynamics are this Tuesday morning?
Well, good morning, Sean. Well, I think there's not much dynamics today, at least, but talking about a $10 move, I think that the risk of that one is still to the upside. We've just seen this past week just the first signs of potentially China easing on their lockdown, strict lockdown rules, potentially sending the market, or has sent the market higher. That will happen sometime next year, and that will trigger a boost to demand, and it probably will be broadly commodity positive. So that the EU sanctions from next month, I mean, it's like playing an old record, right? By now, we all know the three major themes. We got OPEC plus production cuts, EU sanctions, and then we got the health of the global economy weighing it down. But I think still the market is tight. We're still seeing some of the crack spreads around the world being very elevated, still signaling that the refineries are running flat out to produce enough of the products that we are using.
Clyde Russell, Asia Commodities and Energy columnist with Thomson Reuters, sitting in Australia. Clyde, I feel for your news colleagues today as they come up with the headline that I'm not quite buying, which is that oil prices fall as China demand recession concerns outweigh supply woes. My sense is that we've shifted from demand destruction concerns to supply concerns, and this assault on 100 is simply suspended. Your thoughts?
Well, I think, having done it for many years in a past life, the sort of daily writing of headlines is quite a trick. Yes. Because there also has to be some kind of fundamental reason as to why oil is doing what it's doing. But the truth of the matter is, if it's up 1%, down 1% or 2%, nothing's really happening. So, I do sympathize with my news colleagues on writing those headlines. I think the broader market sort of themes are still there. If I'm looking at the risks, I think the risks are more to the upside at the moment rather than the downside. Although one of the upside risks that has got some attention of late is the sort of planned, or the rumors that China is going to reopen and do away with COVID restrictions. That's not something I'm 100% convinced of. I think the Chinese will very much chart their own path on this sort of thing. And I think what they're likely to do is try and ease little steps at a time, have, sort of, if they are doing lockdowns, have a much more targeted, it's a very evolving response in China. And you've actually got to look at what they say and do rather than what Western media reports are saying they're going to do, because quite often those are two very different things. So I expect that we're still going to have some form of COVID restrictions going on for quite some time to come. Will they just get better at it and more targeted? I think that's probably likely. But I think the sort of idea that at some point in the new year, you're going to have a massive kick up in Chinese crude oil demand because the whole economy is open and running, I think that's probably a little bit fanciful at the moment.
Yeah, I think there's a certain prism, I suppose, at least from the Western posture, that we're looking at China like we look at ourselves. Geez, they must be fed up with this lockdown nonsense. I want to go to the beach. And clearly the Chinese, one has to remember they have very real challenges. They have a very large population with a very low vaccination rate, of a vaccine that has fairly low impact or record of performance, and they have an aging population. I mean, the fundamentals on the ground with an Omicron virus still loitering. I mean, 1 and 1 is 2 there, and I think it's always important to remember that this isn't some kind of luxurious choice they're making. They have a very real problem.
I think you've actually hit the nail on the head there. The challenge they face is somewhat different to what we in the West faced in dealing with the virus. And you've got to think of, what is the path that's most likely to deliver them the success that they want? I mean, are they likely to want to open up and let COVID run rampant as we have done so in the West, relying on the vaccines to, keep deaths and hospitalizations lower? I don't think that's the Chinese way, to be quite honest. I haven't said anything that suggests that that's the path we're going to take. So I think it's quite likely that they are going to continue with some form of COVID restrictions, lockdown, and use that, sort of overwhelming control power that the state has to ensure compliance. So I think, it's how does that translate into energy demand? Well, it means that things are going to be not quite as stellar as people hope. Just as we've also seen, their stimulus spending and all, the sort of attempts to boost their economy haven't really resulted in that much of a pickup in crude oil demand. Almost all of the crude oil demand, that extra that we've seen in the last couple of months, is just simply being re-exported as products because they finally allowed product exports. So that's kind of the China dynamic at the moment.
Rustin Edwards, head of fuel oil procurement, Euronav in Europe. Rustin, what's the sentiment there? It seems like the worst case scenario in terms of the winter and supply constraints is not yet transpiring. Where is Europe at the moment between this battle of kind of demand destruction versus supply concerns?
Well, I mean, we were talking about it before. There has been some demand destruction from the consumer in general, just because the net gas consumption is down in a lot of different areas. But, it's also been relatively warm. October was a fairly warm month, so utility demand was not as high as everybody was expecting, which has allowed stocks of natural gas to continue to build. There's been plenty of headlines out about the amount of ships waiting offshore to discharge their LNG cargoes. Now, some of those are logistical constraints. I think some of those are also opportunistic constraints where traders have moved cargoes into region in hopes that there will be a pop at some point. But nevertheless, I mean, I think that the demand destruction is taking hold in some aspects versus others. Gas oil is still a tight molecule across the world. The French strikes that have finally come to an end have not helped in that matter, because they took about 900,000 barrels a day of refining capacity offline for the better part of 4 weeks. Which usually you hear about that happening in the U.S. Gulf Coast through a hurricane, not through a industrial action by a bunch of union members. So that's kept the distillate story still relatively tight, and there's still a fair amount of people who need distillate, and a lot of industry needs distillate. So it's going to keep those cracks on a strong footing going forward.
Ole, I'm trying to understand the situation in Europe. Clearly, obviously, the worst case scenario, Armageddon, has not yet happened, not yet. But even more than that, we've seen the major index of Europe, the German DAX, have a significant recovery over the course of the last month. It had a low that dipped below 12,000. Now it's well at 13,500 on the DAX. I mean, this is looking like an economy, at least if the equity index is a reflection, in pretty good health. How do you sort of square that circle, so to speak?
Well, it is still quite difficult, but I think the market is the market is responding to obviously what's happening elsewhere. The bounce in the Chinese stock market this week is obviously something that's welcomed by Germany. It's a major exporter. But at the same time, the spot prices that we're seeing in gas on the screen, which is still above 100, that's we at the same time we got some immediate delivery prices, probably half that. So in terms of the cost of gases, we are getting down to levels that we saw almost last winter. So that's obviously having an impact. And then I think just the belief or the fact that we're having this mild winter so far, that the demand is falling off a cliff. So that has again eased concerns that we may hit some problems, at least or reduce the risk of a major supply issue this winter. Next winter is still a big problem, but generally the market is at this moment in time wants to trade the market from the optimistic side. And we've seen that in the US as well, even though we are still nowhere near peak conditions in terms of interest rates, but the stock market is managing to find a bid on a regular basis.
Clyde, I'd like to just look a little bit at where the outlook for China is on a more granular level. You had your column out today about, don't believe the numbers, so to speak. We saw Chinese oil imports pop above 10 million barrels in October. It seemed like a return to fairly solid import numbers from their part. Give us a little bit more granular deep dive there into the China import picture and their appetite for discounted Russian oil, or what does the story tell you at this stage?
Well, I think there's several factors behind their October numbers and what we're likely to see in November and December as well. The first, obvious one that's a temporary factor is two rather large refining units started up or in the process of starting up. They're about 520,000 barrels a day combined. You need operating inventories to start up your units. I'm told by refining people that that's typically about 3 weeks of inventories. If you do that, that's roughly 11 million barrels that would have been extra demand that won't be repeated, so to speak. That obviously all didn't arrive in October. They've probably been building it up over time, but you are actually looking at, that's a little temporary factor that polished the numbers. You also have looking at other factors. As I mentioned before, they have allowed more exports of refined fuels. They were relatively strong again in October. And in fact, if you look at August, September, October, those are the 3 strongest months for refined product exports since July last year. So they have definitely ticked up. They're still down on a year-to-date basis, but you've certainly seen a big pickup in the last couple of months. So a lot of the crude that's coming in is simply being refined and re-exported. And that's actually a very good thing for, product markets. You've actually seen, the gas oil crack in Singapore come off, from August, when it was close to like $60 a barrel. It's now down around 32, 33. So you have seen the sort of impact of Chinese product flows, sort of helping out the very tight markets there. We have seen, sort of more crude import quotas being granted to the independent refiners. They'll have to use those by the end of the year. So that might add to a little bit of incremental demand on the imports for November, well, in October and for November and for December. But none of this is being led by a rebound in the Chinese, domestic economy. It's not like we're seeing massive amounts of extra fuel being used for construction or other sorts of activities. In fact, that kind of stuff is actually looking, sort of weak, especially on the shipping side. Quite a lot of, Chinese product demand is for bunker fuel and things like that. So that's starting to come off quite a bit. So my sort of overall impression is that, it's the external sector of exports of fuels that is kind of driving the sort of mild recovery in import of crude. On the other side, we also got slightly cheaper prices in October. The Chinese love to buy at a bargain. You did see the Saudis drop their OSPs for October, so that actually pushed them to buy more Saudi crude. And in fact, it looks like they bought more Saudi crude in October than they did from the Russians, which would be a bit of a turnaround from recent months. They are still buying quite a lot of Russian crude. I believe the discounts have gone down a little bit on that, but there's still a lot of interest in that. So, overall, it's not a bad picture. Crude demand is real. That is improving slightly in China, but it's still running at weaker levels, sort of year on year. And there's not really much impetus on the domestic side to say, oh, that's coming back. I mean, I admit that if we do get some COVID easing restrictions and the world economy doesn't fall into a big hole, then China could be a very positive story for the first quarter, second quarter next year. But
it certainly feels like everybody sort of waiting for that one definitive headline. Rustin Edwards, the head of fuel oil procurement, as we said earlier, in terms of the outlook for Europe and the decision to embargo Russian oil from December 5th, what impact, or is there a trauma now being seen in shipping, given that we're starting to see announcements of insurance policies being withdrawn and so forth? Where are tanker rates at the moment vis-a-vis these new flows?
Tanker rates are sky high.
Still.
They're still sky high. It's all a ton-mile story at this moment in time. There have been reports of alternatives have been put in place against the EU and the UK insurance schemes, P&I clubs, what have you. And so the flow is moving. I mean, I think Russia has secured enough tonnage to move all their waterborne exports to other markets as long as they find buyers. So I don't think the missing oil will actually materialize to the scope that everybody's predicting come December 5th. I think they will find ways. There'll be some logistical hurdles that will have to be overcome. But I think that, and if you look at what the G7 price cap is insinuating, that all you have to do is land the oil into a tank and then it's no longer price capped. It kind of opens the door for a lot of possibilities of how Russian flow can be moved from point A to point B and get back into a non-price cap, non-sanctioned state. So
are we migrating towards a non-event here? I mean, it seems the whole US strategy has been to sort of bring in a non-functioning price cap in order to dilute the impact of the European sanctions, generally speaking.
I personally think that it is not going to be as hard as a lot of analysts are pointing out. I think there is going to be some reduction, but I don't think it's going to be 1.5 million. It might be half of that. Because again, I think they've secured enough vessels, or there are enough vessels that have been, let's say, moved out of the commercial fleet into the dark fleet trade to handle the flow. And there are alternatives, and those alternatives have already been exercised since the war began, because back in February and March, a lot of the EU and UK P&I clubs said they were not going to cover Russian oil, period. And so they pulled out of that trade already. So to say that you're going to sanction it even more, you might lose another 15-20% that's already operating under a different operating mindset and under a dark trade already. So I don't think there's going to be much of an issue.
Ole, you had been forecasting for when we had our forum in Fujairah a month ago now, that you expected to see rates, the interest rate cycle, the tightening cycle, peak towards the end of the year. It looks like your forecast may be correct. I'm wondering, where do you think that is at and its intersection point with the energy markets? It seems that maybe we're getting to a point now where indeed that has all been priced in. Has it? Your thoughts?
I don't think it has just yet, but at least we should start to see some of these extremely high CPI numbers start to revert lower eventually. That will bring some relief, but it does look like at this point that perhaps again driven by the US, that we are getting close to peak rates, because these rates are already biting hard. We're seeing all these stories about mortgage rates, how much higher they are now compared to just a few months ago. So we are seeing a delayed impact on the impact of these hikes, and I think that's potentially also why even though the FOMC right now cannot signal any stepping down, but at the same time I think they will be getting close to taking a pause, or at least slow down the pace of hikes, just as simply to see the impact of what they have done already. And I think the same goes for Europe. We started hiking quite late. And clearly here it's more of a balancing act in Europe, because we're hiking into much more weakness than we're having in the US, where they're hiking into strength still. So that's creating a discrepancy. But for Europe, perhaps the weaker the weaker euro has helped somewhat as well. Looking at some of the container shipping rates, they have all been falling like a stone. The only one that's been kind of kept up has been the out of Europe bound trade. So that has potentially alleviated a little bit of the pain we're seeing elsewhere.
I mean, there was, Ole, I welcome your thoughts on the obviously the last week, and we have inflation CPI numbers coming this week, but the last week of the Fed decision, and then the employment numbers, I still feel a little dizzy as to exactly what it's telling us. What's the tea leaves of all of those things combined? We have the Fed saying, oh, we might step back a little bit, but we're going to go higher for longer. So what are your sort of headline takeaway from all of these ECB move, the UK move, and the Fed?
I think in the US it's quite simple. It's the FOMC is data driven. So they are making sure that the market maintains a tightening focus, but at the same time they're also saying that this is going to be driven by incoming data. And as you said, the data on Friday, the job report, was a bit of a mixed bag, but generally still showing strength. So the market reaction to that one, where we're actually seeing bond yields drifting lower and the dollar lower as well, is a bit of a surprise. And I think it's also just indicating that the market is looking for for these data to start turning south sooner rather than later, and that will trigger this kind of the FOMC taking the foot off the pedal. Because we have to remember as well, higher interest rates, that also means higher interest rates for the Federal Reserve, and in terms of the cost that it has to carry the debt, it's the debt load it has. So I think there might be a limitation to how high yields can and will go at this point.
Clyde, one of the questions that seem to be emerging as we get all of these sanctions stock up is the dark fleet of oil storage, floating storage around Malaysia and Singapore, Iranian, Venezuelan, now Russian. I was asking earlier in the week, I'd welcome your thoughts on how significant that is from a scale point of view. Is there a market transparency on it? Do we know the volumes and then order to be able to assess? I mean, there was reports earlier in the year that Iran was ready to unleash 60 to 100 million barrels. How big is this floating storage now, do you think? And what is its relevance to the market dynamics?
I think you've got to separate out the sort of various types of dark oil that's going around the world, from Venezuelan to Iranian to Russian, and who exactly is dealing with it and how they're doing it. I mean, you can actually make fairly good estimates just simply based on satellite tracking and human tracking of tankers that have turned off their satellite tracking services. You still get people sitting on shores counting ships. I mean, that's still a thing. And there are services that do that. So we have a fair idea, not perfect, of how much oil is out there. One, I think it's a lot less on the Iranian front than people think. And I doubt the Iranians could get all their oil to market very quickly. What you are seeing is there's quite a lot of people willing to move Russian oil around, but that's always comes at a cost. So, if you want to ship, particularly from Russia's western ports in the Baltic, and sort of ship that out to Asia, that comes at a cost. It's the shipping rates are quite high. As Rustin said, tanker rates haven't really fallen very much, so that's going to be quite expensive to do. There are people who do it. Will the cap, that the US is proposing and the EU proposing, the price cap, will it work? Probably not. Traders are really good at getting around it, but then I had a conversation with a couple of US officials, and they actually don't really privately expect it to work that well. What they really want is just to make life difficult for President Putin, cut his profit margins, make it harder for his oil operators to actually get things moving and get things done.
Well, harder for everybody, it would seem. Well, in the sense that it's harder for the whole industry. Rustin, the same question to you. Generally speaking, we talked a little bit, or referenced earlier, we got a floating sort of armada of LNG vessels off the coast of Europe. We now have a floating armada of tankers in around Malaysia, the Straits of Malacca. Is that significant? Is that in fact impacting the rest of the flows and availability of ships, or?
Well, I mean, that's the reason why you have stronger ton miles. Mainly there have been ships that have been pulled out of the normal commercial flow to go into these alternative flows, and mainly it's into the Russian flow. So yes, I mean, the price cap as it comes into play is going to impact markets to some point. But again, like Mitch Clyde said, I believe the traders are very smart. They'll figure out their workarounds, and it'll have minimal impact when it actually gets implemented. Will it make things difficult? Possibly. But that just depends on the capacity of third-party insurance providers and also country-to-country insurance providers to cover the expense of the voyage and the risk on the voyage. I mean, the one thing today is that, yes, in the world today, there are less incidents regarding ships and ships traffic than there used to be in the past, because navigation's gotten better, technology's gotten better, the quality of the ships have gotten better. So I don't think we'll see a rash of groundings and collisions that some people are worried about because of these dark ships running around the marketplace, not with their AIS operating, but you still have radars and what have you, so they can be tracked. But nevertheless, I don't think there'll be much of an issue. I think, again, the tanker rate story for the clean freight market, which I'm saying is the ones that are not in the dirty trade, will continue to be strong and supportive. And much to the ships engaged in the dark fleet trade, they are getting compensated higher than what you're seeing in the normal commercial fleet. I mean, we've heard stories of ships that are being done at $150,000 a day to move from Penrose to China, which That rate on a normal ship, 70,000. So you have an incentive if you're a ship owner to make that trade happen.
Absolutely. Let's get the survey question and then get a round robin from everybody on the big election today and the other geopolitical backdrops that we're dealing with. Have oil markets already priced in higher interest rates for longer cycle? Have they? Yes, no, partly. I was just going with a yes and no, but I gave a partly just to give everybody an out because it seems it's somewhere in that mix. Ole, a big day today, U.S. elections. Is it indeed a big day? I welcome your thoughts on that. And what other the geopolitical backdrops? Of course, in your neighborhood, we have still the raging Russia invasion of Ukraine. How big a factor is that continue to be in terms of the markets?
Well, the midterms, first of all, it looks like we are shifting going to shift a bit to the right, potentially to a bit more energy fossil fuel friendly camp. Whether that's going to have an impact on the oil majors and this stale kind of stale production growth we have right now in the US, that remains to be seen. So probably not expecting much of an impact there initially. In Europe, it's still we're still in the midst of the this battle, keeping everyone on board with the battle, and thereby also suffering accordingly in our wallets. So that obviously is a process that will continue throughout the winter and into next year. So we obviously everyone hopes that there will be some kind of an approach between Washington and Moscow. There was obviously some rumors about that over the weekend. So let's see. Otherwise, this could be end up being a forever war where we basically have a line, and then that's we're going to get stuck at that for a while, and that's obviously not healthy for anyone.
Clyde, we have also the growing sort of battle of words, if you like, between the US and Riyadh and Washington. We have also the resurgence of the Iran or the Houthi conflict in Yemen, which had gone quiet for a number of months when the outlook for the Iranian nuclear talks were looking positive. That seems to have come back in the headlines with threats to Saudi oil infrastructure. Your thoughts on some of these geopolitical backdrops, obviously the election today?
Well, I don't think the U.S. election makes too much difference, to be honest. I think no matter who ends up in controlling Congress and whether you end up with an effective lame duck president, it doesn't really change the U.S. energy position that much. I think if you're looking at the other geopolitical things, there's always risks in the Middle East. There's always a risk of attack. There's always a risk of outages. We saw that, now a couple of years back when one of the big Saudi facilities was hit. So there's always that kind of risk, but you can't really plan for that. You just got to deal with it when it happens. I think, for me, the major theme is still we're basically in a race between recession fears and recession realities already in some parts of the world, and the sort of determination of OPEC Plus to keep prices at least in that $90 range by keeping production limited. History suggests that recession always wins that race, but this time it could be different.
Rustin, your thoughts on that? We'll just get the survey result first, but I wanted to bring up, yes, the oil markets have priced it in, is the most, I will put that on social media, see where the wider audience thinks. But the move to the right, Rustin, we've seen in Italy, the new prime minister there, Meloni, is holding the European line vis-a-vis Russia, although we had seen demonstrations on the streets of Italy this weekend, sort of anti-war, quote unquote. We've got the Republicans in the US signaling that they might pull back some of the money for Ukraine. That sort of erosion of the Western position, your thoughts, is that a potential victim here of a Republican win?
Well, I don't think it's a potential victim of a Republican win. I mean, what you have in the United States is the clear dynamics of a unpopular president. Biden's approval ratings have not really skyrocketed anything above 50% since after he was elected, and you've got an economic slowdown. And I think the problem that the U.S., or at least the Democrats, have faced in the United States is that they forgot the key words from Bill Clinton's successful campaigns. It's the economy, stupid. The Democrats' message has been completely devoid of an economic message. The Republicans have been hammering home inflation, poor economic conditions, and that's resonating with the voters. And that's why the Democrats aren't going to win. They had a bad message going into the midterm. Nevertheless, I think what the biggest risk that you have in Europe, and you're seeing that in Italy, is the fact that you are getting war weariness. There's a lot of money being spent on the support of Ukraine, yet when you are the person sitting in your village and you're trying to figure out, how am I going to keep my home this winter? How am I going to feed my kids this winter? Sending billions of dollars to a country at war with another country doesn't make a lot of sense. And so I think there's going to be a lot of political strife that has to be dealt with, as constituents are going to be challenging their representative leaders. Why are we doing this when I can't even heat my home? And that is, that comes down to the brass tacks of living versus trying to be a global standard in which you try to hold other people to.
Yeah, that clearly, I suppose, is in the strategy of the Putin war machine, that they were always gambling on the winter squeeze and the European resilience, and we're going to have to see how that plays out. I mean, the whole world is getting a little bit war weary of the impact. No matter how close you are, it does feel it trickles everywhere.
But the constant nuclear saber rattling done by the Russian government, I mean, that just adds more anxiety, which, it is a tactic to try to get people to not support the Ukrainian side of the conflict.
Yeah. And of course, we'll have to see. I mean, Kiev is under the front, obviously, the front line of what will be a very, very cold winter in Ukraine. Obviously, that's always the case. And with their energy infrastructure nearly practically destroyed now, it's a serious situation. And the images coming out of there over the next few months will also be quite powerful. That's where it's at. Geopolitics still a big backdrop. The outcome of today's election will just feed into that noise and have its own impact in due course, one would think. Thank you, Ole. Really appreciate your participation and insights today, as always. Clyde Russell in Australia, Rustin Edwards in Geneva. Thank you guys very much. Look forward to catching up every morning at 10:30 UAE time. All the best and have a good day.
You too.
Cheers.
Thank you.